Decentralized Finance, DeFi, removes financial intermediaries from the financial ecosystem. Instead, participants exchange assets and services in a peer-to-peer fashion. This includes borrowing and lending, taking long and short positions on cryptocurrencies, and earning yield farming returns. However, DeFi poses significant challenges. For one, it is vulnerable to hackers. It's a decentralized system. Decentralized finance is an emerging technology that uses blockchain and cryptocurrency to create a financial system that is not controlled by any central authority. It is designed to reduce the need for intermediaries such as banks and exchanges, creating a more democratic and global alternative to traditional financial services. However, it is not without its risks. The decentralized finance system allows people to buy and sell assets without a central server, making it easier for them to make trades. It also uses smart contracts, which are computer programs that can automatically execute transactions when certain parameters are met. In addition, the decentralized system is able to store and transfer digital assets securely, ensuring that all parties follow through on their promises. One of the biggest issues with this new technology is the vulnerability of its blockchain systems to hackers. Hackers can potentially steal funds or even take control of a network. This is why it is important for anyone considering investing in this space to be aware of the risks involved. Currently, DeFi is used in a variety of ways to support simple and complex financial transactions. Typical transactions include peer-to-peer lending and borrowing, crypto exchanges, and NFTs. It is possible to earn or pay interest on these activities, and many have rates that update as often as every minute. Some users even trade assets for short periods of time, similar to stock trading. Some DeFi providers offer leverage and margin to allow people to multiply their returns. This is done by using cryptocurrencies as collateral for loans, with the value of the assets locked in smart contracts until they are returned. This has seen massive amounts of capital flow through these solutions, with some lending protocols commanding billions in total value locked, TVL. There are several benefits of using DeFi, including its fast, low-cost settlement and its ability to process a high volume of transactions. It is also a good choice for those who want to invest in new industries that are in early stages. But it should be noted that these investments can be highly volatile and have a high risk of loss. It's a peer-to-peer system. Decentralized finance, or DeFi, uses blockchain technology to manage financial transactions outside the control of central institutions. This process cuts out middlemen and creates direct connections between lenders and borrowers. It also reduces the barrier to entry for services like loaning money. These features make it possible to transfer value anywhere in the world and at low cost. Traditionally, every financial transaction you make is processed through an intermediary, such as a bank or credit card company. But with DeFi, those middlemen are replaced with public blockchain networks. This technology is programmable and immutable, so it increases security and transparency. In addition, it supports an integrated economic system. The blockchain is a digital ledger that records all transactions, both big and small. This means that anyone can verify the accuracy of a transaction without requiring permission from a central authority. Additionally, this technology has a built-in security mechanism that prevents hackers from accessing your private information. As a result, DeFi is considered one of the most secure forms of financial transactions. But it's important to understand the risks of investing in this space before you start using it. This is why it's best to seek professional advice from an expert. When you use a DeFi application, you store your digital assets in a crypto wallet that you have complete control over. This makes it impossible for a third party to freeze your funds or charge you fees for exceeding a minimum balance. In turn, this allows you to transfer funds quickly and at a lower cost than traditional banks. In addition to lending, DeFi applications can offer a variety of other financial services. These include savings, investment, trading, and market making. This trend has inspired product developers to integrate DeFi protocols directly into their platforms. This is known as composability, and it has opened up opportunities for product developers to create innovative incentive models. For example, the Ethereum-based Pool Together is a no-loss audited savings lottery that enables users to purchase tickets with the DAI stablecoin. These tokens are then lent to the compound money market protocol to earn interest. It's a decentralized market. Decentralized finance is an emerging market that uses blockchain technology to cut out intermediaries and enable people to exchange crypto assets directly. Its promise is a more creative, global, fast and open financial system. However, it also raises challenges that must be addressed before it can become a mainstream reality. DeFi involves a variety of financial functions that are typically performed by intermediaries such as lending and trading, but without any central control or supervision. Its mechanics are based on the security protocols of different cryptocurrency blockchains and smart contracts, embedded computer code that automatically executes transactions when predetermined conditions are met. It can be used to perform traditional financial transactions such as transferring money or exchanging assets. Bitcoin was the first DeFi application, allowing users to transfer value globally instantly and at low cost. But more than that, it allows people to truly own and control their money, removing the need for centralized institutions or banks. Moreover, it is unhackable and impossible for governments or companies to shut down markets or change its rules. A number of DeFi solutions have emerged that allow users to trade and swap their digital assets, such as peer-to-peer borrowing and lending, exchange services for non-fungible tokens, NFTs, and crypto wallets. Many of them are built on top of existing Layer 1 blockchains, but some, such as the stablecoin Ethereum stablecoin and Aave, operate on their own. This approach has several benefits, including forcing blockchains to compete for developers and traffic and leaving more room for other applications on top of the platform. The DeFi sector is growing quickly, with solutions commanding billions of dollars in total value locked, or TVL. Lending protocols are particularly popular, with the average DeFi solution attracting more than $7 million in capital. It is expected to grow even more as more and more users take advantage of the opportunity to make investments with cryptocurrencies instead of traditional stocks and bonds. The decentralized finance industry offers potential for outsized returns because it removes middlemen and eliminates the fees they charge, but it can also be a Wild West. For example, the IRS can't easily trace and collect taxes on digital transactions because they are pseudonymous and usually happen on permissionless blockchains. It may take time for regulators to catch up with the pace of development in this area. It's a decentralized ecosystem. Decentralized finance is a new financial system that uses blockchain technology to remove third parties and centralized institutions from the equation. The system allows individuals to transfer funds in minutes and hold them on secure digital wallets. It also eliminates fees that banks and other financial companies charge for their services. It can be used anywhere in the world, and it is accessible to anyone with a computer or mobile device. The new system is based on public blockchain networks, and transactions are conducted without the need for custodians, central clearinghouses, or escrow agents. Instead, these functions are assumed by smart contracts which are embedded in the blockchain network and execute when certain conditions are met. The result is a faster, more cost-efficient and more secure transaction process. Using DeFi, people can perform many financial activities such as lending and borrowing money, buying and selling assets, taking long and short positions in cryptocurrencies, and investing in real estate and yield farming. The system can also enable financial inclusion for the 2 billion unbanked people worldwide who are currently excluded from the financial world. In addition to removing middlemen, DeFi offers security advantages by dispersing risk. For example, if a single company holds all of its customers' data in one place, hackers can easily target that location and cause a security breach. However, if data is stored across multiple locations, a hacker would need to access several sites at once, making the system more resilient against attacks. The DeFi space is growing rapidly, but it is still at an early stage. The new system has a number of challenges that must be addressed before it can take off. For example, there are concerns that the increased competition may lead to higher investment industry costs. Moreover, the growth of this sector may increase financial stability risks. Consequently, it is important to conduct research to evaluate these impacts. Moreover, it is important to make DeFi data available so that researchers can use it in their studies and inform policy.